Now we're going to talk about overstating assets. Why overstating? Because that's what people do when they commit fraud using assets. You don't want to understate assets. Assets are good. You want to say you have more of them than you really do. So, can occur in many ways. If you put something on the books that's property, plant, and equipment, some physical asset, just don't depreciate it enough. Right? And it's easy to do. You say it's got a higher residual value than what it is. Oh, it's going to last longer than what it really is. So you take smaller depreciation expense. That's easy enough. Who's to say they're estimates anyway? Capitalize expenses. Huge way of overstating assets. Right? Because if you take an expense, I don't know, some startup costs and stick them in a deferred expense account or a patent or something, now you got an asset and not a liability. So that's all great stuff, right? And if you are capitalizing expenses, guess what? Your net income's overstated because you didn't take those expenses. Everybody's favorite thing, higher net income. All right, so you got a lot of different assets on your balance sheet, and different assets can be overstated different ways. So here we're looking at, you've got cash and short-term investments, receivables, fixed assets. When you have a merger or acquisition, you're going to consolidate, and you have to put values on these different things and maybe even have some goodwill. So there's a nice spot where you can come up with some bad assets. And intangibles and deferrals, these are just like, what numbers do we want to put in that, right? So you gotta watch out for that. Capitalizing expenses, humongous asset fraud. Big way of just getting a double bonus. You get more assets and fewer expenses. And fewer expenses mean higher net income. So, as you learned in intermediate accounting, you can capitalize some expenses. It's appropriate in some cases. So what we have to do as fraud examiners is look and see, is what they're doing appropriate? Are they classifying those costs appropriately, right? Is it supposed? So you have to know your accounting pretty well and know that expense can be capitalized, that can't. Why do they do that? Well, they're doing it to manage earnings. All right. Companies want to have steady growth. They want their earnings curve to go like that, just kind of nice and steady and up. They don't want, up and down, volatile. They certainly don't want down. How flat or steep the curve. The steeper the curve, the better, but even a flat, slightly flatter growth curve is better than no growth. And you certainly don't want losses. So they are not like stealing money because, right, they're accruals, they reverse, right? So if I capitalize an expense, well, eventually I'm going to have to amortize it in some future period, right? So this is the slippery slope, right? Because accruals reverse, in future periods, eventually I do have to take that expense. So now I'm taking it in a different period is all, right? So they start out kind of deferring these things, but then it seems like just a little earnings management, now they're having to keep up with this. They're having to manage even more earnings, and they're having to really now lie. And that's where they're getting like completely non-GAAP based accounting. So it's a slippery slope when we start doing these things. When a merger occurs, you often get a chance to revalue some assets, and you may get to have something called goodwill, depending on what you assign as your book values on stuff. So, good place to inflate some assets. Mergers and acquisitions. Property, plant, and equipment. So, when you have fixed assets or natural resources, you want them to be more than they are, right? Because if you can take less depreciation expense, on a PP&E type asset if you can take less depletion or however you use up that asset on a natural resource. That's one less expense or a lower expense. Lower expense means higher net income, right? So underreport depreciation. So how can you do that? Well, you can say the residual value is higher than it really is, so you're depreciating a smaller number. You can say it's going to be a longer lived asset than it really is, so you depreciate over 10 years instead of 5. Just underreport depreciation. Leave them on the books. So even though some asset is not worth anything, but you haven't fully depreciated it, so you're leaving it on the books. Selling an asset and leaving it on the books. I've had that happen, actually. I don't know that I've ever personally seen anybody fabricate a fixed asset, but they do, right? And so these are just different ways. Cash and short-term investments. It's hard to overstate cash because you can do a confirmation with a bank, right? But they do it. They fake bank statements. They intercept confirmation letters. Employees stealing cash will make fake documents to cover what they're doing. So you can actually have overstated cash. It's a lot easier to overstate investments, and a way they'll do this sometimes is not marking them to fair value, right? Saying that this asset is for some other purpose and we can carry it at cost instead of writing it down when the price has gone down, stuff like that. Take them completely off the books altogether. This last thing, that's like what Enron was doing. They would make a special purpose entity, they would sell the asset to that entity and the liability that went with it and take all that stuff off their own balance sheets and stick it on the balance sheet of Chuco or whatever crazy fake company they made up. So just take them off altogether. Receivables. It's pretty easy to overstate. Now, we learned when we were talking about revenue problems that, hey, if you're faking revenue, you're going to have to fake a receivable, right? We've already talked about that. Typically the typical way accounts receivable gets overstated is related to revenue fraud, all right? But you can have employees doing things like stealing cash, and they're stealing the receivables coming in, and they'll keep those on the books. So again, a little listing, you can go to your book and look at all we've talked about, the various ways to overstate assets. So what can you do to find these asset fraud symptoms, right? Well, assets are overstated are on the balance sheet. So it's harder. So with liabilities, they're understating them, right? So it's harder to find something that's just not there, right? It's like, well, do they have a liability? How am I going to find that? I'd have to call up the person they owe the money to and ask them, or it's just not there, right? But an overstated asset is on the balance sheet. So they've got, here's my PP&E, right? Here's my warehouse, here's my equipment, here's what depreciation I'm taking. So I can look at that. I can say, you say you have a warehouse. Does it exist? There it is. So do you own it, right? Go to the courthouse and get the papers. Do you have, is it worth what you say it is? You're depreciating it over 100 years, excuse me, right? So you can do that, right? So that's nice. You'd say, okay, well, what are they saying they have? They're not going to understate assets. They're going to overstate assets. So the first thing you're going to look at is whether there's some deferred charges. So on startups, Some accounting rules let you defer some charges until they start making revenues, so you want to look at those. And what you're supposed to do is go find the documentation that shows these can be capitalized. Same thing with into any kind of intangible, right? You want to make sure that it's what they say it's worth. It's not impaired in some way, right? If you have a copyright to some software that nobody buys anymore, it's overstated. That's worthless, right? So same thing with mergers and acquisitions. Here's a great time to try and put stuff on the books that's not worth anything. Oh, I bought this from this other company. It's a patent. It's a copyright. It's something that other company owned, and it's worth this. And maybe it's worth nothing. That's not why you bought the company, but you can put some different values on it. So you're having to. It's a little. At least there's something to go to. They're saying what it's worth, and you can find out, is it really worth that? Obviously, cash. They don't do that much. But they do. So easy enough for you. Get their bank statements, get their reconciliations, look at them, see what's happening, and you can verify it. So it's pretty easy to verify cash because there's going to be a number there, cash, this amount. Go verify it. Same things with marketable securities. So marketable securities, there's a market for them, the NYSE, NASDAQ, something like that. So you can go look and see and find out if they really own it, right? You can find out the ownership of these items because they may say they have stock they don't have. So you can check with the broker or transfer agent, however they do this, however they keep their stocks. Overstatement of receivables or inventory. Almost always when receivables are overstated, revenues are overstated. You wouldn't put them on the books if there wasn't a revenue that goes with them. When inventory is overstated, cost of goods sold is understated, right? We've talked about that last chapter. Once in a while, they're overstated to hide theft, right? So some kind of employee occupational fraud is going on, and they've done something with the books to hide the theft. That's when you might have to find that. So again, the same way we would verify receivables under revenue fraud, we verify them this way, send a confirmation, something like that. And when we come back on our next video, we're going to talk about disclosure fraud.